Welcome to the Deep Dive. I'm John,
And I'm Wendy. We're staff here at StayWired.
and we are here with your weekly shortcut to being well-informed, the weekly StayWired recap.
Today we're focusing on an economic challenge that probably hits closer to home than the interest rates or inflation figures you see in the headlines. We're going to be dissecting the sources that argue pretty persuasively, I think, that the real cost driving this modern sense of exhaustion is what we're calling attention is the new inflation.
Right, so our mission here is to understand the crushing weight that's been placed on our mental bandwidth as consumers.
A lot.
It really is. I mean, we're talking about a reality where you're now expected to spend 12, even 13 hours a day consuming media and facing an estimated 35,000 decisions. We want to unpack the economic fallout of a world that is, well, basically designed to deplete your focus. So let's jump in.
Let's do it.
So the core idea in this research is, it's actually simple, but it's pretty profound. In today's digital economy, we pay for things not just with dollars. We pay with our focus. Our mental bandwidth has become this incredibly scarce resource, and it's being strained by what the sources call a deluge of messages.
And that deluge, it's not just a feeling, it's measurable. Research from WeWire and McKinsey has actually quantified this strain.
Okay.
Think about this. The average American is spending between 12 and 13 hours every single day engaging with media across multiple screens.
12 to 13 hours, that's basically all your waking life.
It's a huge percentage of it, yeah. And it's all dedicated to just processing incoming information.
And then you combine that constant input with just the sheer volume of choices you have to make to get through a day. You start to see why everyone feels like they're perpetually behind.
Exactly.
There's this one study, it's cited everywhere, suggesting that the average person makes over 35,000 decisions a day.
That number 35,000, it sounds outrageous on the surface, doesn't it?
Yeah.
It just suggests a level of conscious thought that feels, well, impossible.
It does. I mean, am I really choosing 35,000 things? What even counts as a decision in that measure?
Well, it's crucial to understand the methodology there. It includes everything from the big stuff, like choosing a new health plan.
Sure, the high-stakes decisions.
Right. All the way down to the micro decisions. Which link should I click? Should I check my phone right now? Should I scroll past this ad? Which email gets my attention first?
Okay, so it's the constant mental overhead.
It's exactly that. The overhead required just to exist in a connected world.
Yeah.
And those tiny, tiny decisions, they add up fast. They accumulate into real cognitive exhaustion.
And this accumulation, this leads directly to what analysts are calling decision fatigue. You feel it most intensely when you're trying to buy something.
Yeah.
It's that moment, you're staring at a product page with 15 different options, and instead of choosing, you click the back button or close the laptop.
And we see that fatigue reflected so starkly in the consumer data. When you poll shoppers, something like 30 to 40% of those who say they struggle to complete a purchase, they attribute that difficulty specifically to having too many products to choose from. It's the paradox of choice, and it's become this paralyzing economic drag.
Think about the practical examples from the sources. 5, 10 years ago, choosing a bank account or a credit card, it was tedious, sure. But now, you've got the financial complexity layered with this digital complexity. The focus it takes to read 50 different reviews, compare loyalty programs, navigate the apps, all while you're trying to filter out the marketing noise.
Even deciding on breakfast cereal is a project now.
It's a mentally taxing project. And when every small choice like that has a tax on your attention, you instinctively shift your behavior to defend what little mental energy you have left.
And that results in what the research is calling purchase hesitation. When the cognitive cost of just engaging with the product is too high, the rational thing to do is to delay buying it or
just avoid it altogether.
More often, yeah, you avoid considering new products completely.
And the forecast for this consumer defense mechanism is pretty alarming if you're trying to market something new. The forecasts are warning that by November 2024, roughly 2/3 of the market,
67% of consumers.
67%.
Yeah.
Are expected to hit peak marketing fatigue.
And that 67%, they aren't just annoyed, they are actively disengaging. They're tuning out the redundant ads, they're skipping new product research.
So what's their solution?
Radical simplification. They're sticking exclusively with familiar, trusted brands, even if it means they might miss out on a slightly better deal somewhere else.
Because the cost of comparing has just gotten too high.
Exactly. The cost of comparing the options has exceeded the actual value of finding the optimal choice.
So this scarcity of attention then, It translates directly into massive economic spending.
It has to. I mean, if two-thirds of your potential customers are actively trying to ignore you, breaking through that fatigue becomes exponentially more expensive.
And that expense is, it's staggering. We're talking about the global digital ad spend, which has recently topped, what, $600 billion?
Up to $667 billion a year. That colossal figure is the price businesses are paying just to try and pierce that cognitive fog for a split second.
To put that in perspective, we have the 2023 regional spending data. The U.S. was projected to invest about $264 billion in online advertising alone.
And China was right behind, spending another $136 billion. This kind of capital being deployed, it just proves beyond a doubt that attention is the single most expensive, most sought-after commodity in the modern market.
And this spending spree, this is the mechanism of attention inflation. Marketers are caught in this vicious cycle. They have to spend more and more just to secure a moment of your time.
And what do the platforms themselves prioritize?
Well, they gauge their success not by the quality of the user's experience, but literally by how long they can keep users glued to the screens.
Which leads us to what the sources call the perverse incentive.
Yeah.
If a platform's success metrics are purely based on maximizing time spent and engagement, regardless of the user's well-being, then the system is naturally incentivized to amplify content that triggers urgency, anxiety, or compulsion.
So the platforms profit most when we are compulsively engaged, restless, constantly clicking, not when we're satisfied or informed. It's an architecture of depletion.
And this dynamic, this is what gives rise to the idea of mental inflation.
Explain that.
Mental inflation is the hidden cost. Even if the official CPI numbers show that your cost of living is stabilizing, the actual effort required to navigate your life has gone up.
Okay, give me an example.
Think about planning a trip now versus, say, a decade ago. It's not just the price of the flight anymore. It's the effort you spend comparing 15 different booking sites, filtering out dynamic pricing, checking your loyalty points, and then dealing with the flood of confirmation emails you have to sort through.
That added cognitive burden, the 35,000 decisions, and 13 hours of media processing, that makes the world feel fundamentally more exhausting and, well, more expensive than the headline inflation rate suggests.
Exactly. We're all paying a psychological premium with our attention, and the digital economy is expertly designed to extract profit from that very psychological drain.
And this cognitive load, it just gets worse during certain times of the year.
Oh, it intensifies sharply when you look at seasonal pressures, the holidays specifically. The sources note that this attention inflation really hits a critical point during the traditional shopping season.
It's not just shopping. It's a full-blown blizzard of extra notifications, sale alerts, travel deals, gift guides, all competing for that same limited focus we've been talking about.
And the numbers show this really critical tension. On one hand, 61% of consumers are planning to increase their holiday spending.
But on the other hand,
Yet almost two-thirds report feeling completely saturated, overloaded by marketing by the time November is even fully underway.
so the implication is clear. Consumers are trying to meet the demands of the season.
Buying gifts, organizing travel, trying to get the good deals.
But the mental effort required is turning what should be a cheerful time into genuine stress. And this huge cognitive cost is a factor that our standard economic indicators, like the Consumer Price Index, they completely fail to capture it.
Right. The CPI only measures the price of the goods, not the psychological toll it took to get them.
Which highlights this growing blind spot in how we measure the economy. Researchers and analysts are now suggesting we need entirely new metrics for economic wellness.
Metrics that explicitly account for attention strain, for decision fatigue, for this mental inflation.
Because if we don't measure the cost of effort, we can't truly understand the quality of life in a digital world.
So the prescription then, for businesses and for policymakers, it has to move beyond just simple marketing tactics. The sources suggest that reducing unnecessary cognitive clutter could be one of the most effective inflation-fighting strategies we have.
How would they do that?
Well, whether it's through radically simpler design, hyper-efficient product targeting, or even regulatory frameworks that target addictive engagement practices.
So it's about returning agency to the user. Giving people back control of their attention is no longer just some soft, feel-good strategy.
No, it's an economic imperative. It's aimed at reducing this systemic mental inflation.
Okay, we've established that this overwhelming cognitive friction is a psychological issue, but it also creates real turbulence in the capital markets. It drives hesitation and reallocates vast sums of money as companies fight for that focus. With that in mind, Let's transition smoothly to a rapid analysis of this week's key market movers, straight from the StayWired report.
All right, starting with global economic updates on GDP and rates. We saw Swedish GDP growth confirmed at a modest 1.1%,
Okay.
and French growth was confirmed at 0.5%. The Bank of Korea, meanwhile, held steady, keeping rates at 2.50%.
But the big moves really came from Africa. The Bank of Ghana delivered a massive 350 basis point cut, bringing its benchmark rate way down to 18.00%.
A 350 basis point cut is a huge signal. This reflects a growing confidence in Ghana's inflation outlook and stabilization programs. It's a major stimulus for their local economy.
And in contrast to that stimulus,
In contrast, Egypt's GDP showed really robust expansion, growing 5.3% in the first quarter of their 2026 fiscal year.
okay, and what about major policy and sector movements?
Japan announced plans to issue over 11.5 trillion yen in new bonds, a massive issuance designed to finance a recent economic stimulus package.
And in China,
Solar installations grew by 30% in October, which signals continued strength in their renewable energy infrastructure. And the UK, planning ahead, approved a 4.1% rise in the national minimum wage for 2026.
now pivoting to FX movements, let's look at year-to-date strength. African currencies have shown some significant resilience.
They have. The Ghanaian cedi, so the USD-GHS pair, maintains a very robust year-to-date appreciation of plus 26.2%. It's one of the strongest performers globally.
We also saw a strong recovery in the South African rand, the USDZR. It posted gains both this week and this month.
Right, bringing its year-to-date recovery to a significant plus 8.35%. That rebound suggests renewed investor confidence in emerging markets with strong commodity links.
And globally, the British pound, the GBP-USD pair, advanced 1.28% this week. That locks in a strong year-to-date gain of plus 5.71%.
Conversely, the Chinese yuan, USDCNY, weakened year-to-date by 3.02%.
Which is deliberate policy.
Right, that's right. The yuan's weakness reflects that the People's Bank of China is actively supporting the domestic economy, often by allowing a gradual weakening of the currency to keep their exports competitive.
And let's wrap up with the commodities view. Oil saw some volatility.
It did. It fell early in the week on reports of softening geopolitical risks, specifically around Ukraine peace talks, but it later recovered. Brent crude settled around $63.34 a barrel.
And gold.
Gold, the ultimate safe haven asset, found firmer footing. It was really underpinned by disappointing U.S. retail sales data, which fueled speculation that central banks might cut rates sooner.
Right.
Spot gold hit its highest level on November 26th, reaching around $4,162.99 an ounce. That rise confirms that when core economic data looks shaky, capital runs to safety.
And finally, a quick mention of the top 2 most active stocks that came through our investment ideas list this week. NVIDIA Corporation, trading around $164.92, rated as a strong buy.
And NIO Inc., listed at $3.90, carrying a buy rating.
So everything we've discussed today really highlights this hidden cost of modern life.
It really does. Every ordinary transaction now carries this psychological price tag, and it's determined by the scarcity of our own attention.
Absolutely. And I think the tension we identified is the most critical takeaway for you, the listener. That conflict between facing 35,000 decisions every single day and the fact that nearly 2/3 of consumers are now so fatigued they're just choosing to tune out.
Which means the majority of that marketing spend is just hitting a brick wall of cognitive defense.
It really forces you to ask whether businesses are truly creating value for the customer.
Or if they're just extracting bandwidth from them. The economic environment is now demanding that we manage human mental capacity as carefully as we manage production lines.
So here's a provocative thought for you to carry into your week. If global digital ad spending is soaring, topping that $600 to $667 billion mark, yet nearly 2/3 of consumers are confirming they are tuning out. What happens when the economic cost of chasing attention completely overwhelms the actual utility derived from that fleeting focus? Is a fundamental redesign of digital engagement, one that prioritizes simplicity and rest over compulsion, not just inevitable, but essential for our economic stability?
That is the pivotal question that will define the next decade of technology and commerce. Thank you for joining us for this deep dive into the source material.
We'll catch you next week on The Deep Dive.
StayWired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the StayWired Weekly Recap.